Today is Tuesday, February 4th, 2025, and this is Sliced. Blended finance, a key catalyst for climate action. The need for climate finance has never been more urgent. We are watching disasters unfold in real time. Wildfires reducing homes to ash, floods leveling entire communities, and heat waves pushing ecosystems to their limits. Although global climate finance reached an all-time high of nearly $1.3 trillion in 2021 and 2022, this is still nowhere near enough. According to recent assessments by Climate Policy Initiative, annual climate finance flows must increase by at least sixfold to meet the scale of the crisis, reaching $8.5 trillion per year between now and 2030, and over $10 trillion per year from 2031 to 2050. Without this level of investment, keeping global temperature rises within 1.5 degrees Celsius by the end of the century and avoiding the worst impacts of climate change will be out of reach. Traditional financial systems are simply not built for a crisis of this scale. If we want real change, we need to rethink how money moves. As we wrote about in the first Our Take of the new year last week, Impact 2025 predictions, in the realm of impact investing, we believe 2025 will be the year of blended finance, as the combination of public, private, and philanthropic capital continues to gain traction. This approach reduces risk for private investors and enables the mobilization of large-scale capital to address climate change and sustainability challenges. Enter blended finance. Blended finance takes capital from public, philanthropic, and private sources and strategically layers it to reduce risks that typically deter investors. It's not a silver bullet, but it is proving to be an effective mechanism for scaling up climate investments. By absorbing some of the early risks through grants, guarantees, and concessional loans, governments and nonprofit organizations help create the conditions that make climate projects more attractive to institutional investors and commercial lenders. This approach doesn't just unlock more capital, it catalyzes momentum, making climate solutions viable at a scale that would otherwise be out of reach. Out of the areas where blended finance is making a measurable impact is in natural climate solutions, particularly sustainable agriculture and forestry. These landscapes do more than just support biodiversity. They're among our most powerful tools for pulling carbon from the atmosphere and stabilizing the climate. Yet, financing these solutions has historically been a challenge. Blended finance is changing that. Farmers are gaining access to capital that allows them to adopt regenerative practices, restoring soil health while keeping carbon in the ground. The Land Degradation Neutrality Fund is one example, directing investment into sustainable land use projects that rebuild degraded ecosystems. Meanwhile, long-term financing structures like the Tropical Landscape Finance Facility in Indonesia are ensuring that forests continue to provide economic and environmental value rather than being cleared for short-term profit. These aren't just theoretical models. Blended finance is already at work in the real world, shifting billions towards critical climate projects. The climate investment funds have successfully mobilized private capital to expand renewable energy and build climate resilience. The Green Climate Fund has blended public and private capital to fund climate-smart infrastructure in vulnerable regions. The And Green Fund has given investors the confidence to back large-scale conservation projects, knowing that some of the financial risks are mitigated by public and philanthropic partners. These successes illustrate the power of blended finance in bridging the gap between ambition and action. That said, no financial mechanism is perfect. One of the most significant challenges facing blended finance is ensuring that public funds aren't just subsidizing private returns. If too much risk is offloaded onto public entities, private investors may become dependent on these guarantees rather than building self-sustaining financial models. The complexity of blended finance structures also raises concerns about transparency and accountability. Are funds reaching the communities that need them most? Are projects delivering on their promises? These questions highlight the need for strong policy frameworks and rigorous oversight to ensure blended finance works as intended. Despite the challenges, blended finance is set to play an even greater role in the climate transition. With carbon markets expanding, impact investing gaining traction, and governments tightening sustainable regulations, there is a growing recognition that traditional financing models alone won't cut it. New financial instruments like blue bonds for ocean conservation are emerging as powerful tools to scale climate solutions even further, as shown by the International Finance Corporation, or IFC. The momentum is building, but only if governments, investors, and financial institutions commit to pushing it forward. Blending finance won't solve the climate crisis on its own, but it is one of the best tools we have for closing the investment gap and mobilizing resources at the scale this crisis demands. The opportunity is here, and the need has never been greater. If we want to move beyond theoretical commitments and into transformative action, we must lean into blended finance with everything we've got. The climate isn't waiting, and neither should we.